Just to give you a bit of a primer, I think we didn't really have like a specific set of questions for this. So I think we're just gonna like kind of talk to you about like sort of your deal, maybe some of your opinions on the fintech space. And if you want to like talk shit, we can just talk shit for the next 20 minutes.
Sure.
Well, I think it's interesting. Yeah. I mean, well, yeah, let's just tee it off then.
All right.
What was, should I just start or what?
Meeting investor 11. Just got a call from the lawyer that I need to get 5. Oh, okay, fine. He's not joining. That's fine. Okay. Yeah, why don't you do the intros and I can tee off the conversation.
Hello, Barbarians, and welcome to a special episode of the LLB podcast, Low Level Barbarians, from Asia on Asia, with debate and discussion on trending topics. Today, we have a special episode. We are with Zac Liew, right? Good friend of Dave Chang, Man of the High Ground. And Dave, I guess you said you want to tee us off, so why don't you let us know what's going on and why we're here?
Yeah. So for those of you that are in the know, Zac, I've known Zac for also like 6-7 years at this point. So he is the founder and CEO of Curlec, which is a direct debit fintech company. And they were recently acquired by Razorpay out of India for 20 million US dollars. And so very happy for Zac. Zac's been he's a good friend. He's a super nice guy. Couldn't have been to a nicer guy. He has handsome hair. So I feel like it would be interesting to get Zac on the show, to talk about the deal, his experiences, his outlook for fintech in the region, and then just any general commentary. So why don't we start this way? So I was thinking about how to start this conversation, Zac, and what's the best entry points. And I think for me, one of the most interesting aspects that I know about your business, and maybe it's not common knowledge out there, is your relationship with your co-founder, Steve, right? So you guys kind of have a relatively substantial age gap. I believe 36 years is your age gap. So it's a bit atypical for a start.
That's very anti-Silicon Valley, right?
Yeah, so it's a bit atypical, right, for sort of like the traditional narrative of startup founders and sort of relationships. So maybe we can start there, give us some context about how you and Steve started working together, the dynamics of your relationship, and what's it like to have someone that's maybe on a bit of a different, at least lifestyle than you when it comes to work. And I'll let you go from there.
Yeah, and to be clear, also you are the CEO, so Steve was in a different role, I'm guessing, right?
Yeah, I mean, he's a director of the company, but sort of, okay. I think at our stage, it's sort of jack of all trades at this point. I mean, it is obviously outside of the norm. We often joke that we both went to the same school. I was a kid at the school and he was a parent. And we, when we started the company, when we founded the company back in, 2017, 2018 time, I was 26, he was 62. So we were the direct inverse. So, we had some running jokes in the office around hashtags like 2662 and all that sort of stuff. So it was pretty funny, but in terms of our relationship, we've got a really great relationship. I think, and sort of, when I strip that back a little bit, why do we have such a great relationship? Obviously, we are close family friends, but also, it's Steve's way of working. He brought me into the business. He's obviously given me a lot of free reign as to sort of, what we do with the business and responsibilities, but also at the same time act as a mentor, and I think, from what does seem maybe a strange arrangement, particularly when it comes to sort of startups and sort of, founding teams and stuff like that. Yeah. Actually, I think it's been a big advantage to us. He is sort of the old head, he's sort of run many businesses before, been in the corporate world as well, and sort of, run sort of very large teams. But on the flip side, I bring a young, fresh perspective, and certainly, that, I suppose I'm not going to say drive because he's very driven as well, but just a different perspective. Mm-hmm. So, I think the two combined are definitely big advantages that we find. And, I think, we bring the best of both worlds.
Interesting.
Yeah.
I mean, one of the things in my experience, one of the primary drivers of startup failure is founder friction. and when founders, either butt heads and come to a junction where they no longer agree. So I'm just curious, given the dynamics of the relationship, like how do you guys handle, sort of not necessarily conflict, but differences in opinion, whatever you want to call it.
Yeah, it's a good. The weird thing is we haven't had that many arguments.
Wow.
Lucky.
And all the way through an
Lucky.
acquisition.
Yeah, all the way through that. Wow,
Yeah.
that's
Amazing.
Verified air, man.
Yeah. I mean, we disagree about a lot of things, but I think particularly when it comes to a work setting, obviously, we are sort of different ends of the spectrum in terms of sort of age, but sort of ego is always left aside. Business comes first, and then sort of, when you take sort of, view things black and white and stuff like that. I mean, at least, we haven't really sort of gone into sort of big arguments. So, I think disagreement's always healthy, particularly when it comes to running companies and stuff like that. But yeah, no, everything has been pretty great, and I don't know whether, again, that stems from the fact that, we've known each other for many, many years, which is, and sort of very intertwined in that perspective. But yeah, no, I can't really share much on sort of falling out.
Well, I think there's some things we could pick out for people to learn, and especially like what aspects are you holding firm on? Because like you said, you do disagree. So where are you holding on? And I'm sure it's not the type of relationship where he's an older guy and then you will just acquiesce just to experience, right? So I'm sure there's what areas are you really standing firm on? Where areas are he standing firm on? And then what does that look like when you try to, I don't know, find the middle ground, I guess, to and the right answer is whatever's successful for the company, right? So like, how do you get there?
Yeah, I mean, that's a good question. And I mean, just thinking of, one sort of example would be, and I don't know, so, and again, this sort of comes back to sort of having a good sort of combination in terms of where we are in life. I am, well, when we started the business, I was 26. He was obviously 62. First time entrepreneur. Had no idea what I'm doing. To an extent, to an extent, still the case. But I mean, how we ran the business. Initially, for example, he's very conservative. He will always joke, "Hey, I'm a Welshman," which is, he jokes, is worse than being a Chinaman. So he's super tight when it comes to costs. In the flip side, you got me, who's sort of like, like first time entrepreneur, exciting, raise a bit of VC funding, etc., let's spend. So I suppose after sort of many conversations, you sort of meet in the middle. We can't be super tight, if we want to grow this business. But on the flip side, we can't be sort of typical startup style, just go big, and subsequently end up at, well, nowhere really. So, I mean, that's just one example of where we've sort of taken different views, and sort of you had to meet in the middle.
Well, if you guys think about all your friends who are also entrepreneurs and maybe have good, successful partnerships, don't you tend to think that's the dynamic? Someone is like super out there trying to just, grow and do everything. Other person is very grounded and very execution oriented, makes it kind of work, right?
Yeah.
I feel like those tend to be the best partnerships that I see. I don't know if you guys see the same thing.
Yeah, no, I agree with that.
Yeah, I agree.
Yeah. I mean, so another thing is like, direct debits for me just seems sort of like the way that I always sort of understood your business and the way I always viewed your business. Actually, it seemed like you guys had decent market traction like right away. Like you didn't actually have to go through. Again, this is my perception. So correct me if I'm wrong, right? So you guys had sort of like decent product market fit from the get-go, and so I'm curious. Since you didn't have to go through that process of finding it, or maybe you did. But like, assuming that my analysis is correct, what was the most painful thing in the early days? Then? Like, what was breaking the most? What did you have to spend most of your time doing?
Good question.
God, I'm trying to re-rack my memory here. I mean, we had product. I wouldn't say we had product market fit, but we built the product very incrementally. There is, and again, always starting from that sort of base, which is we're solving a problem, as opposed to sort of have a solution looking for a problem, and built the product pretty incrementally up from that. I think sort of in the early days when I look back, a lot of the, I suppose not issues, but the challenges we had to face. Obviously, we're a B2B company. There are not that many B2B fintechs or SaaS companies in Malaysia, period. And certainly are a few more now. But, obviously you've got to sort of convince clients to go to the cloud. Not only that, you've got to educate the market around sort of, in our case, it was around recurring payments. So you have to educate people constantly around sort of why you should do this, why you should do that. It's okay for your customers to sign up for this. It's such a new product, and things are super, super sensitive when you get to sort of money and financial services. So educating the market, of course, sales, learning sort of how we could get off the ground on that front, particularly when you are a small company, particularly when it's sort of you're up against, in some cases, banks and stuff like that. It's a credibility issue. So, I suppose in the early days, those were really, really the big challenges, to be honest, challenges we still face, but becoming a little bit easier on that front.
Yeah, I mean, I think there's like an interesting point you made there. Like when you're saying like there's not a lot of B2B SaaS businesses based out of Malaysia. And I think that's objectively true. And I'm just kind of curious, like, in your analysis, why do you think that is? Like in my opinion, I always thought Malaysia was a pretty fertile ground to found a tech company. There's like good, well-educated workforce. Everyone speaks English. The infrastructure is okay, regional access. But yeah, for whatever reason, it just doesn't seem to have like, it doesn't seem to be a popular angle of approach. I'm just, curious, like what your thoughts are about that.
I think generally speaking, the business community has been quite slow to adopt tools generally, up until maybe about 2-3 years ago. And obviously COVID has accelerated that, extremely quickly. So, nowadays, I think you're sort of constantly seeing sort of the new startups popping up. Generally speaking, you see a lot more B2B as opposed to B2C consumer plays. I think that's just a general shift in sort of everywhere, but particularly Southeast Asia, we're starting to really see sort of a lot of capital pour into that space too. So, whilst I think business adoption has been slow, I think we're sort of picking up, and hopefully we'll see a lot more fertile ground for, businesses such as ours.
Do you think you're seeing this, that the capital is pushing the trend, or the entrepreneurs are finding the problem and pulling the trend to solve it for these businesses?
Yeah, that's good. That's a good question. That's a good question, because I think we would argue that, the entrepreneurs pushed it, but
of course. Well, maybe with your acquisition now.
Maybe. But I think if you look at the States, for example, I think the general trend recently has been shifting away from sort of very high burning consumer businesses into sort of B2B plays. We're seeing that play out here as well, right? So and I think VCs are getting wiser to sort of just very high cash burning businesses, and just buying market share, etc. So you could answer it both ways. I like to think the entrepreneurs are pushing it though.
Sure. All right.
You're not biased at all. So, well, let's maybe then shift tacks a bit and talk about sort of like the investor space, and I think your deal in particular, right? So, I mean, as our listeners of the show typically are pretty well informed, so I think everyone here knows that it's like a very frothy time in the VC market. So, as a young, ambitious guy, and whose company's doing well, you're growing well. I think you guys grew like what, 300% year over year last year, like some really impressive metrics, right? So like, I think the question that everyone always asks, the natural question is like, why sell? Why not keep going and see how far you can take it on your own?
Yeah. So I think first things first, it's not a full acquisition.
Sure.
So it's a majority acquisition. And in effect, Steve and myself still retain a stake in the company, so there is plenty of upside still. Which I think is so we view it that way. I think on the whole, the deal was a win-win for all involved. Sort of, our existing investor or previous shareholders who've left us, who made a good return in sort of 2-3 years. And for founders, our employees, clients, etc., and of course Razorpay. Why we chose to do this, I think it was really, when we took a step back, it was really saying, how can we go where we want to go and as quickly as we want to do it? And the more we spoke to the Razorpay team, the more we sort of understood their business, what they had done. The parallels were just, really, really there. They built up some incredible scale in India. But, in terms of the thesis, the vision of the company, their product set, really, really aligned to us, and obviously being part of a $7.5 billion company versus, a company which was way less than that in Malaysia, it certainly would help us to give an opportunity to really go fight the big boys, not only just in Malaysia, but, in Southeast Asia, etc. Serve our clients better, give our employees, a better opportunities. And I think, obviously sort of from a personal level as well, still retain a lot of upside, in the future. Yeah. So, I think it was a win-win-win-win for everyone. Yeah. And sort of, I think, once you draw away past the ego aspect, particularly, then, I think it made sense.
So if I'm reading in between the lines, there's a big potential for headwinds for competition going forward. And I think the way I think about B2B, after talking to a lot of SaaS founders in the regions, and there's only a handful that are like really, I think, competent and know the space well, is that depending, of course, which segment you're looking at, you're only talking about customers in the thousands, maybe for Southeast Asia alone, which is, I mean, it's a big TAM, but it's a very different kind of game. And to win trust, you're talking about longer sales cycles and this kind of thing, and more hand-holding in the Southeast Asia region, which is West, looking for more tool-centric type of SaaS where they do it themselves, right? So, I don't know. Do you feel that that you needed to do this deal to compete with the Grabs because they're pushing into financial? Shopee's doing pay. Is this just a feature stack for Razor, or is it just purely the really, like they say, the story, the narrative is that this is really just the entry point for the gateway to Southeast Asia? And then why Southeast Asia if that's the case?
Yeah, so I think from the Razorpay angle, this is definitely a gateway into Southeast Asia. Sure. These guys are the number one in India. The team behind it are sort of incredible, and the products they've rolled out. And I mean, in effect, they are the Stripe of India. By a long way. They've obviously, want to replicate a lot of that success into Southeast Asia. As an example, in India, UPI payments, which is sort of the real-time payments infrastructure that sits in India. India's got the largest real-time payment network in the world. Obviously, they've got 1 billion people. Yeah. And by default, these guys are the largest player in the market. So they process the most real-time payments in the world, which is incredible for a company which only started up in 2014. What we are seeing now in Southeast Asia, which we think presents a big, big opportunity, is the fact that we're starting to see this infrastructure roll out here too. As an example, in Malaysia, you've got Do It Now, and now you guys see it, you go to the store, you see the QR code, and that's point of sale type of transaction. What we're going to start seeing.
Sorry, but to clarify before we move forward, to Do It Now is basically mandated from the government, which is like an infrastructure in the banking system.
That's right.
Where everyone is connected by. Actually, I'm not sure what it is behind technology-wise.
So Do It Now is just it's a real-time payment network that is a bank-to-bank transaction, and all the banks in Malaysia are part of that scheme. All the banks, as well as sort of the e-wallets. So in effect, it's using that network, a domestic network, versus using an international network like Visa and MasterCard.
And I think that actually did power the QR code movement you're seeing, right? Like I see, like more prevalently, I see like Touch and Go, which is basically the highway card for paying toll, right? But everyone's part of this network. So, but now I see them doing QR pay everywhere. Is it because of Do It Now?
Well, I think if you can recall, Alex, a few years ago, you'd walk into a restaurant, and you go into a restaurant, you probably want a buffet or whatever, but what you get is a buffet of QR codes at the checkout.
Yes, correct. Yes.
And for a consumer, it's like, dude, am I really gonna download 10 apps?
No.
And this is when sort of e-wallets were sort of going crazy at the point. Now what you're starting to see is interoperability, right? So there's a single QR code, and no matter what sort of app you have, whether it's a banking app or an e-wallet app, you use it now. It's through a single network where all these guys are connected through a single entry point, through a single network. It's called PayNet in Malaysia. It's Bank Negara owned subsidiary. In effect, that's what it is. What we're gonna see with Do It Now, and this is traditionally in Malaysia, sort of without getting into too many technicalities around sort of payments, everything hasn't been real time. And I think you guys have also been and you guys are also in the e-commerce world. When we look at other forms of payments, take cards as an example, they can be expensive. And in some cases, particularly credit cards, very low penetration rate in Malaysia or Southeast Asia, Southeast Asia just generally. What we're now going to see with Do It Now, which is very, very similar to how UPI played out in India, is you're going to see real-time transactions, which are pretty close to free. And you can now access through your bank account, your e-wallet, et cetera, et cetera, et cetera. And this isn't started off in the point of sale world. It's going to go online. It's going to go into recurring payments. So we are very, very bullish as to how this plays out. And in India, what we see is that UPI payments, which is sort of what I just described, now in terms of market share is around 30-40%. In the next sort of 2-3 years, they expect it to become a monopoly around 70-80%.
Yes. In effect, you become a Visa, MasterCard, but for this new infrastructure, basically.
So Visa, MasterCard is a network, and the Do It Now rails is another network. I think what sort of following what they has happened in India is that when you sort of put the two up, particularly with domestic-based payments, you're going to see a lot of flow start to go through the domestic network. Which is very different to sort of how a lot of the payment gateways have been built, particularly in Malaysia. You think about the incumbents, IP88, GHL, who traditionally are very sort of card-centric companies. And with these payments being very, very close to free, it's like, how do you make money on a transaction that's free? In India, it is free. So it's really around wrapping services around it, whether it's financial services, software services, et cetera, et cetera. So when we look at it from this perspective, Malaysia's a few years behind India. And we're starting to see that play out here. Very, very, very similar trends on a macro level. And for them, entering this market made a lot of sense. Like I said earlier, the thesis we have around sort of not just focusing on payments, but the services around it, monetizing elsewhere. Something really sort of very, very consistent between our two companies. So I think for them was an entry point to Southeast Asia. For us was obviously we can operate at different scale that we have chosen, we have been able to previously. And when we start with Malaysia, we're seeing very similar trends, sort of, probably behind Malaysia, actually, funny enough, play out in Thailand, Singapore, to an extent in Indonesia, where these real-time payment rails all come in. And we think it's one of the biggest disruptors we'll see in payments for a long, long time.
Interesting.
My last question before, because I'm hogging, I know I'm hogging the questions too, sorry.
No, it's fine.
So how as a business and how as a consumer should we think about different companies' payment as payment providers, like, Shopee Pay, Grab Pay, Go to Pay, like how does that work with these new networks, right? Because literally I'll just scan one QR code, but then it's going to get redirected to one of these other guys, right? And they're taking a slice. So how do we think it from a business perspective and a consumer's perspective? Or a consumer probably won't care. It's just easier for me now, right? And I guess that's where Curlec can benefit, right? But then what does that mean for the business side? They're all competing for what?
It's a good point. So I'll start off with the business perspective, or merchants. At the end of the day, what a merchant cares about is predominantly price. And secondly, value. How do you provide value for access to these payments? What we're going to see is the price severely go down. It's going to be very, very close to zero. From a transaction fee perspective, which businesses are like. Bank Negara is pumping this a lot, and incentivizing a lot of businesses to move on to this world. Then really comes a question about how do you provide services to access the network, Of course, I'm a small merchant. I'm a micro merchant. I've just set up a storefront, but the payment's free. But how do I actually, list my storefront? Send payment links, all that sort of stuff, right? So we sort of view ourselves sort of really coming into that space strong. From a consumer's perspective, at the end of the day, consumer it's all about user experience, right? And because it's always free. and stuff like that, in terms of consideration. I think one thing that we could potentially see is maybe a little controversial, is potentially the death of e-wallets. So, with everything starting to go through the network now, banks will become part of the network, and in effect, an e-wallet is a pass-through account.
Yeah,
correct.
It's a store of value of whatever, up to 1,000 ringgit, like 3,000 ringgit, etc.
I think that's true for a lot of the early guys who tried to play this game, but they couldn't really figure out what the product market fit was, what they were really trying to solve, long-term for driving long-term value. But I would argue for something like a touch and go network where I have to drive every day, transportation infrastructure, you can't really remove that. So that's going to be a little bit stickier, I'd say, probably.
Yeah, that's fine. But, in terms of you think about the user experience right now. I go to an e-wallet. What I have to do is I top up the e-wallet, and then spend the e-wallet. Now through these do it now rails, I'll be able to go direct to the bank and have this exact same experience.
Yeah, you're right.
All these merchants, which then, again, I go back to India and how these things have all played out. Paytm obviously have lost a ton of market share, because they were very focused on the P2P space, and then subsequently UPI comes out now, and you can't make a lot of money out of a payment that's free. I think from a consumer's perspective, it's just going to become a lot easier. We'll start to see shifts in sort of the actual applications you'll use to make payments, long term.
So I guess now your ambition is going to have to be very similar to Razorpay's. How do you think about expansion then? Because going to each market, you'd have to get licenses, you have to get partners, I guess, you have to rebuild teams. And then does this mean there's going to be a unified network across Southeast Asia in the future, or is it all just going to be fragmented?
I think, we all know sort of Southeast Asia's fragmented period, and
so it's not going to change.
But particularly when you talk about financial services, it's even more fragmented, in terms of market, right? You're talking about different regulations, different payment preferences, etc. I think, like I said, we're very aligned, with the Razorpay team, as to sort of what it is we want to achieve, and sort of, where we view payments is going just generally. Of course, when we start to scale, regionally, each market will have its own nuances. So it's just adapting to sort of whatever business climate there is, payment preference, et cetera, infrastructure wise. But I think, with the view that longer term, we'll go where sort of, we feel that the payments market is going, which is sort of this shift to real time, et cetera, et cetera.
I think it's an interesting question here, right? Like for people who have started companies in Southeast Asia, ultimately, unless you're in like Indonesia or something, everyone has to expand eventually, right? So, in the framework of like, say, geographic expansion versus like, I think you're sort of hinting at a lot of product or services expansion, right? Like, those are two different ways to do it. But like, what's your framework, towards the approach? Like, which one is better? Where do you start? How do you optimize this?
I think if you sort of the base layer, right, which is really sort of access to infrastructure, payments is really at the core of everything. If you don't win at payments, you're not going to win at the other things, and you don't provide a great payment experience, you're not going to get that particular customer to do all that sort of stuff. So, number one is winning at payments, and going sort of where those markets are, and sort of where we feel they are going is more this shift towards, real-time bank-to-bank payments, et cetera, as well as other sort of payments. Let's not touch on crypto for now.
Our resident crypto fanatics aren't here right now, unfortunately. If they were, they'd be all over this.
So, following that, then you start to talk about the services layer, and particularly around monetization. I provide a great payment experience, but I can't really monetize it. How can I charge 1% or 2%, when the bank is charging 0%? I've got to justify. I've got to justify that, through great software. And so that's sort of the second layer. And finally, third layer is when you start to provide all these layers. When you win at payments, you have the sticky customer because you provide all these software services. Is then looking at other things, such as financial services. In our particular case, potentially stuff around business banking. You've got that customer, you've got all their data, particularly when it comes to financial transactions. And you can start to move into that space too, which is, I mean, like I said, very, very, it's what Razorpay in effect are executing right now in India. They've got the fastest growing neobank in India, which was only launched like a few years ago. But really sort of, you still got to win at payments, and that's really at the core of everything.
Okay, so I guess that's the longer term play, is to be a neobank. Is that the goal?
Good question.
Oops.
Can you not tell us?
Look, I think it's just an exciting time generally in the region. Obviously, we've got the digital banking licenses coming, which should be announced this month, next month, or something like that. And obviously, we're going to see sort of the big tech in Asia move into sort of financial services. We feel more on the consumer side. In terms of the other trends we see, which are going to become very interesting for businesses like ours, is stuff around open APIs or open banking, which is starting to be mandated, a little bit more. I think it's a natural progression for a lot of payment companies, diversifying into other forms of financial services, particularly sort of, business banking.
Correct. Does that mean we start to see the Venmos of each country in Southeast Asia coming? Is that existing? Is that existing anywhere in Asia?
Venmo being sort of a P2P. In fact, Venmo's a wallet, right?
It's a bit more than that, right? Because there's also a lot of stuff going on in infrastructure where they kind of make it semi-real time, right?
Yeah, I mean, without going into too much details around it, I mean, the States is actually, from an infra standpoint, actually a little bit behind us. It's weird. You never thought. So, and also, how these companies can monetize, you talk about sort of interchange rates and stuff like that. These sort of businesses being able to charge way, way more to their customers than businesses here can. So you got to be creative around it. I think this whole notion of, obviously, when we talk about a consumer super app, is really starting to play out here. And of course, Venmo, which is obviously PayPal, is trying to build that up in the States. So of course you got Grab, you got Shopee, you got all those sort of guys who will compete on that front. I think on the business lens as well, you're going to see. Okay, I hate this term super app, but you be able want to do everything. And it's just, I think it's just a natural extension. I think we are starting to see companies do that a little bit. This whole sort of, if we talk about financial services and fintech, this whole idea of sort of, when we trace this back a few years ago, you had companies like ours who were very, very focused on a particular niche, building, excellent products for that niche. And at the time, this whole thing was like, oh, it's the unbundling of financial services, the unbundling of banking. What we're seeing is that the rebundling of all of that. It's number of fronts. Generally speaking, financial services sticky relationship. There's multiple levers to pull when it comes to sort of monetization and sort of creating better customer service, etc. So I think that's a general trend we're going to start seeing. Here.
I mean, I agree with you. I mean, I think that's like the general trend of technology, right? I mean, Alex and we talked about this, where one of the fundamental aspects of technology is it drives these cycles of bundling and rebundling, right? It just happens at different parts of the value chain, right? Like the example that I always use was the media value chain, right? So basically, essentially, Google unbundled newspapers, right? The distribution, editorial, marketing, and sales of newspapers, and then they recreated that bundle on the internet, and they, aggregated all that value to their own bottom line. So I think that plays out. Sorry, you're gonna ask a question, Zach, or not Zach, Alex. Sorry.
No, I was just kind of curious. Like, how do you think about how does the banking role play out in this kind of, rebundling? I guess you could say. Are they partners? Are they acquiring? What do you think they should be doing, or how will you work with them?
Yeah, it's a good question. I think I sort of have a view on this, which I don't know whether it's consistent with what's going to happen or others in the market. I mean, obviously, with neobanking coming as well, digital banking, once you have the Shopee Bank as an example, we're going to see some pretty interesting stuff come out of that. I think just generally, if we talk about incumbent banks, and take a step back, what banks are great at is managing money. What they're not great at is technology. So when we start to take that, as the sort of how we view banks and sort of how we will sort of interact with banks, moving forward, Banks will be stores of money. In some ways, banks will be a set of APIs moving forward, and work with enablers like ourselves, who build that software layer, who build great products and services, etc. On top of these banks, to at the end of the day, work in partnership to create a much better customer service, experience that we can for a business or a consumer, because we all know how much quicker it is for us to ship features and products and stuff to market. Versus a bank who's got to deal with sort of compliance, et cetera. A lot of the IT resources are generally spent on internal technologies as opposed to shipping products. So I think the future is partnering, and our whole notion of what we conceive a bank to be will shift moving forward.
I think that tends to be true. Like, one of my good friends was on the fintech arm for CIMB, and they went around acquiring a lot of digital licenses in Vietnam and Philippines. They launched digital banks there. But I think exactly what you say, they're not going to be as savvy to build out a proper product service, UI, UX. And I think partnering is where they will win then, because one, for a startup to get these licenses can be near impossible to get to, or even a sandbox, unless you're already a domain expert there for a wild family business or whatever, right? So, and then I think, if you want to accelerate the trend, it makes sense just to partner for both sides, actually, right? And then, banks get lower acquisition costs, and then they get the tech side, and then I guess the entrepreneurs win. They get the infrastructure which they need. So I think that kind of makes sense.
That's right. And banks are starting to wake up to that a little bit. Not all banks. I think just generally, we say this to the banks as well, but banks are proprietary in nature, and it's the typical sort of big corporate I can do it all type of mentality. But I think they're starting to wake up, and particularly when we see the more agile, smaller banks, be quite aggressive with here at least, with how they go to market, how they partner with sort of software enablers to do this.
Got it.
So I guess we have about 10 minutes or so left. So what about you? What's on your mind these days? You have any questions, or
what do you want to talk about?
What I want to talk about. So what do you guys see going on in the? What do you think it's going to be the next big trend from both of you guys? Because you both are sort of e-commerce guys, right?
That's our background.
That's the background,
So talk to me about Web3, the Metaverse, et cetera. What are your thoughts?
We have talked about this before.
I hate it.
This rabbit hole goes very deep. So I don't know, Dave. Dave's quite well versed in the media side of the Metaverse. We have discussed at length about it. I don't know. What's your general feeling short term, Dave?
I think we talked about this before, right? I think if we're talking about the Metaverse specifically, I think the Metaverse is it's going to probably roll out a lot like the consumer internet rolled out in the late 80s, early 90s. It's going to be like fragmented. There's not going to be a lot of interoperability. And the dream of the Metaverse as told through sort of like science fiction and popular culture will not be, we're a long way off from that, right? And so my thesis for the Metaverse is actually the entry point is going to be business as opposed to consumer. It's going to be it's going to come in through work, right? So if you think about how the personal computer was adopted on a mass scale, it was actually in the 70s again. So it was actually businesses buying these things to increase productivity for their employees, and then ultimately the employees are like, oh, this is pretty cool, I want one of these at my home, right? So that's sort of like just like a really basic approach. And then like sort of another layer on top of that is, if you think about it, like this idea of sort of a consuming or immersive experience where you spend like 8 to 9 hours of your day doing whatever. In many ways, we already do that. It's like you do that on your computer, you do that at work. Like this Zoom, this call,
work from home
right now is to a certain extent, right? Like we're sitting here talking to each other, we're having an interaction and engagement. So I think that's like a very natural extension of an already existing use case, right? And then I think from the third perspective here is from like a technology layer. There's some pretty substantial technological challenges to adopting sort of like that immersive experience on a gaming context. You guys have played any sort of like VR game in the last, I don't know, like 3 or 4 years. there's a lot of technological hurdles. One is in terms of like connectivity speed, and two, it's just about this. I can't remember the name, but essentially you get like a degree of motion sickness because there's a there's a scientific term that I can't remember what it's called, but it's basically kind of like uncanny valley type thing where it's you can't sustain it for long periods of time. So that's my thought on the metaverse. I don't know.
I'm liking the thesis more about work in the metaverse because, especially what we've been seeing in the news, like we talked a few days ago about India banning Free Fire, right? And so like even China is clamped down. US is pretty free, but like it's it's in its own market, its own world, right? So every podcast will say the on ramp is gaming, but it's maybe a lot more fragmented than you think, especially the way these countries are handling the gaming sector and clamping down, right? So, and then if it is gaming, probably the biggest use case you're going to find is work, like playing a game to live to work, kind of like Axie Infinity, right? Where it's a game, but if you do this like activities in the game, you can actually live off that, right? Which technically is work, right? So that's going to be the biggest use case. So. And we're like they've said, it's very far. Like I think we're very far from seeing anything manifested like in sci-fi where you plug in. If anything, I think if it is work, you're going to see more things like AR in the real life where you're plugged in, and that plugs into other things that send to your other ecosystem at home. And it's going to be a lot of multiverses and fragmentation that needs to be threaded together. Probably like payments too, right? So I think that's how I'm kind of viewing it. But yeah, I don't know. Any thoughts on your end, Zach?
I'm just a listener.
Just absorbing.
Just absorbing. I do have another question. So, I mean, earlier you guys were talking about sort of the VC market, which is frothing. And I think particularly for both of you guys, right? Obviously, you've been in sort of the tech industry, in this part of the world for quite a while now. And particularly now over the past like couple of years, we're seeing sort of just the amount of capital and valuations just go nuts. What do you guys think about it? Sustainable, or or just generally, your thoughts and sort of where the Southeast Asian market's moving around it all?
Oh, I had a really good presentation on this in like episode 3. If you want to go look at it.
I obviously watched it, so I am asking the question again.
Okay. I don't know. Like, do you want to go first, Alex, or I can go first? That's up to you.
You go first.
I feel like on this particular format, I've been pretty consistent in my opinions on sort of the VC market and how it ties back into the overall macro economic market. I mean, you see this in the US, right? Like, inflation rates are coming in at like 7-8%, right? And the Fed has been pretty vocal in their stance towards one, ending of quantitative easing, and two, raising of the interest rates. And you already see sort of some pretty big declines or markdowns in a lot of these like hyper growth companies, right? So like Netflix is down 50%. C is taking a C is taking a shellacking, right? And I think ultimately what's going to happen is you're going to see this trickle down into private markets, right? It's just a matter of time. And and I told the story before, but like maybe a year and a half ago, basically when the U.S. government announced their first round of COVID stimulus, every family office that I talked to was basically saying we're deploying all of our cash into these like basically anything that's a store of value that's not cash, right? Because it's not going to be worth anything. And so that's, I think, driven a lot of like what we see in terms of like people raising ridiculous funds, which then trickles down to ridiculous rounds, which trickles down to all sorts of stupid things. But again, like I said, my position on this is it's completely unsustainable. It's ultimately a cycle, right? Like I think we're at sort of like at the frothiest part of the cycle, and I think we're due for a pretty substantial correction in the near future.
Yeah, my two lines of thought is like you could look at it from a top down or bottom up perspective, and the top down is that you just need to follow the money. So all these VCs, like I think the hottest space still now that hasn't slowed down is crypto. Like they raised crazy amounts of money. So what you got to do is just follow the LPs. Now where are the LPs most affected? And these are very cyclical things. So, we're talking about pension funds, endowment. Well, maybe not endowment funds. Depends how they construct a portfolio, right? So you just got to see that kind of sentiment. If they get hit very hard in a downturn that's going to come, or if they don't, then things continue. But if they do get hit, then they have tighter purse strings to actually allocate more capital into the VC as an asset class, right? So it really depends there from a top-down perspective. It really just starts from the money and how well, which is then tied to the economy and how which is tied to QE and these other things. So that's why macro is a very interesting topic these days. The other way you could look at it, is you're an entrepreneur, like what should you be doing? And I think that depends on what cycle of stage you are. Are you in product market fit? Because if you're in product market fit and you're raising too much and you haven't really found it, just leads to a lot of undisciplined, you probably spending wildly, hiring too much, and then you just having to shut it down in a few years. But now, say for your case where you've now, been acquired, it's kind of different position. If you have a playbook and your goal is expansion and you already know the pain point very well, you should probably be building a war chest kind of like C did, right? Maybe C had foresight in this. So I mean, I used to think of it as black or white. Is it thrifty? Should you take advantage? But it's really depending on where you are and if you have clarity in what you're going to do with the money. But if you don't have any clarity, I suggest to be more disciplined and just raise to a reasonable run rate, like traditional stuff before this crazy past few years. What everyone was saying on podcasts before. But I think it's just very dependent on where you are. But so it's top down, bottom up. That's how I kind of view it. And is this sustainable? Maybe don't even care about that. Just focus. If it's bottom up, just focus on where you are and if it makes sense or not. Right? So that's how I think about it. Yeah.
Yeah,
cool.
Makes sense.
So. Any final comments? I think we're at the closing point. So before your next call, right?
I have a question for you, Zac. If you don't have anything, Okay, this is like a soul searching question, right? So like, what do you know now that you wish you knew when you were younger, or when you started the business, or however you want to approach it?
I know you, so it's all
good. Charm.
He wished he didn't know you.
It's too late.
What do I know now that I don't know?
Like the Faces song,
That I don't know. I mean, I think probably everyone's gone through this, and you just got to go through the experience. There'll be ups, there'll be downs. It's just sort of, for me personally, it's just, you got to keep a sort of an equilibrium around it all, right? Not be affected by the highs, not be affected too low by the lows, and just sort of keep a steady state throughout.
I think you've done that very well, and it's paid off. So congratulations.
Yeah, nailed it, man.
We'll see how it goes.
Yeah. Well, trust me, a lot of us would rather be in your position than anywhere else. So I think you've done well, and just give yourself more credit. So
Thanks, man.
Yeah. Thanks, Zac. Appreciate your time.
Thanks for being on the show. Yeah, appreciate it.
Hey, thanks, guys. Thanks very much.